Okay, here we go. Let's jump in with our slides here then.
Yeah. So just a little bit about us. My wife, Elaine, owns and manages Black Swan Real Estate, Black Swan Living Property Management with myself. If you haven't done the events with us before, just a little bit of credibility, that this is a business that we're in and very active in. And hopefully we've got a few good ideas, maybe a few bad ones, but I think we're right more than we're wrong. But love being in business with my wife on a day-to-day basis. That's my introduction for Elaine there.
Awesome.
We talked about whether or not we're in a COVID era. So this was me at a Braves game in Atlanta a few days ago, and I will remember this forever as the moment in time when COVID was officially over. I mean, I went from being home alone, so to speak, to being in a crowd of tens of thousands of people, no one wearing a mask. Probably not the best thing for public health per se. We don't want to get overconfident. But certainly things are open for business, and this is the reality of the social world that we live in. So it sure feels to me like we're in a post-COVID world there. I see Mark saying he has 0 COVID patients in the hospital today for the first time since March 2020. Wow.
Yeah.
Now that's probably a more salient data point than a picture of a Braves game, but that is incredibly encouraging here. Mark, I know you've been kind of at the epicenter of caring for COVID patients, so appreciate all that work you did and excited to hear that maybe it's behind us. We'll see. Just a little timeline so we can remember where we've been. It was not that long ago that we were in a place of really supreme fear and uncertainty. I know that we kind of pump the brakes on all of our acquisitions and everything from about mid-February until mid-June of 2020. I'm glad we did. I think it was the right thing to do, and then I think it was the right thing for us to do to hit put the pedal to the metal from June 2020 until today, and that's still kind of where we're at. But there's been a tremendous journey here. 2 million deaths, and we can't just assume that it's gone forever, gone for good. We hope it is, but we have to be really careful about that. So I don't know, a moment of silence, I guess, for 2 million deaths.
Yeah, so just to recognize that the presentation today is very real estate focused, very economy and capital focused, but this pandemic is, it had real human lives, so the toll of it, and recognizing, choked up, even though I don't personally know anyone that passed away from COVID, recognizing the real lives around the world that were lost to this illness, the families disrupted, that it's still raging in other parts of the world. Blessedly, we're doing well in the United States, and we've, so many thanks to all of the physicians and nurses and staff and respiratory technicians and people that, in March of 2020 were putting their own lives at risk to care for other people, and all of the work that has gone into managing this pandemic and then rolling out the vaccine and allowing us to get to where we have no patients in the hospital and getting back to normal, but just recognizing that, taking a moment to say that even though we're very focused on real estate in this presentation, knowing that that's, on the backdrop of this is a real illness and a real toll, and that children aren't yet vaccinated. And so even though I think we're all excited to jump into the economy and kind of getting back to normal and traveling and visiting our families, but there are still a huge portion of our population that's vulnerable, and just making sure we recognize that.
Absolutely. So let's talk about real estate.
So I added this slide. Yeah, I added this slide. I was taking just like a really quick break before we put the presentation together, and then I was just taking a quick break to just kind of clear my mind. And I kind of go through several news sources about once a day. I try hard not to get into the media nonstop, but about once a day I go through, and I just kind of chuckled that this was the front page of CNN, right in the end of us putting together our COVID presentation. So you all are living this with us. We're all in this together, living in this post-COVID world, or I like what they call it, the pandemic off-ramp, kind of recognizing that not everyone's vaccinated yet, children aren't vaccinated. There's all sorts of changes in the economy and daily life that are still happening But this is, front page news on a daily basis. And so we're going to try to really hone in on the real estate aspects of that.
Absolutely. Yeah. So we're going to look at today and tomorrow, and then we're going to look at our crystal ball and see how accurately we might be able to predict the future. Some observations here that are probably pretty obvious to people. We're seeing just an exuberant recovery here in the long-term residential rental spaces. So single family and multifamily are both on fire. Single family being owner occupant or rental. Just all-time highs for prices, all-time lows for cap rates. These assets are on fire. We're not going to dwell on that because I don't think that's news to anyone that's here with us today. Lowest interest rates in history. They're creeping up a little bit, and I think they're probably going to go up a lot here in the future. But you have to keep it at the forefront of your mind that we have extraordinarily low interest rates right now. We have a little slide on that in a second. Highest prices, again, no one should be surprised by this bullet point here. One thing that's very interesting is the move in vacancy. So we saw a huge spike in vacancy in multifamily during COVID times, and most multifamily assets kind of had their worst year in a long time in 2020. Meanwhile, those people were fleeing to single family and households were collapsing. So you might have a couple of different generations living together in a single family home, and an owner occupied single family home, or a single family rental, and people vacating 3 1-bedroom apartments to live in one single family home. And that vacancy period appears to have evaporated. So we're seeing vacancy rates kind of at their lowest in history as people now leave those environments and move back into apartment complexes and into single family homes to live in their own. So historically low vacancy, not the lowest ever, but historically low. And then rent growth has come back. So we saw at best stagnant and in many cases negative rent growth for 2020. And rent growth is definitely back with fire here in 2021. So that's just a really quick kind of qualitative snapshot of what we're seeing in terms of long-term rental. You've seen the slide before. What story does this tell? Do you think, Elaine?
Yeah. So when we think about home starts, so that's new construction home builds in the United States. In general, we would expect what we see there in the blue bars, that it stays, pretty steady, but it's generally an upward trend. As the population grows, well, more families means that there's a need for more housing. And then in the decade from 2010 to 2019, so the decade that we've just come out of, we crashed into the 2020s with COVID that totally disrupted everything. But even before COVID, things were changing, because when we go back to 2008 and we think about the home builders that went out of business, many of those home builders never went back into business. There are, huge companies that build homes throughout the country, but the extreme majority of home builders are kind of mom and pop, or maybe like a few generations. They're small, local, regional builders. They'll, build in a city or a county, or maybe a couple of counties for 10, 20, 30, maybe 50 years if they pass it down a generation, and then they're done. And when those folks went out of business in the crash, they never came back into business. Maybe they went and got a different degree, or went into a different profession, or retired altogether, and then they just never came back. And so there's been this impending housing crisis that wasn't super obvious. People in the industry were very aware of it. Nick and I have been very aware of it because we saw it. We lived in Oklahoma City at the time of the crash. Huge new home starts. We both lived in new construction, and then we watched home builders go out of business, and we thought, these people aren't coming back into business. And so very interested in anytime there's a decrease in supply, knowing that demand is going up, the population's not getting any smaller. So scooping up as many houses as possible. And then COVID just really compounded that, when everyone wanted to live in a home at the same time because their children were staying home, they were working from home, and, they wanted space like a yard or something, because even parks were closed in a lot of the country. And so you've seen this slide. I think we present it like probably almost every presentation we do, because it's so important to understand the basic laws of supply and demand in residential real estate, and how that impacts all of the decisions that we make. And we think it should impact all of the decisions that you make.
Absolutely. And, critically, this is not a quick fix kind of problem. It took us a decade to get into this problem, and it's going to take us a decade to get out of this problem. And as Elaine said, in the industry, people have been talking about this for years, declining inventory rates and increasing occupancy rates. And it's kind of a game of musical chairs. So each year it's gotten a little bit harder to find a chair. And then in 2020, 2021, suddenly there were fewer chairs than people, and people are just scrambling, paying anything they can pay to get a seat, to get a home to live in. So we could probably just stop the presentation right there, and that could be your entirety of the takeaway if you just understand that core concept. If you go out and buy a residential long-term rental property, a place where someone needs to rest at night, you're buying into an asset that has projected shortfalls in supply and excesses in demand for the next decade. So I showed a similar chart here in our State of the Market presentation a couple months ago. So this shows that I think it's possible, maybe even likely, that the peak is behind us. These are the number of showings per listing. You don't ever see this on Zillow and stuff. You need local MLS access to get access to this data. This is really, really granular data. And you can see we had this like hockey stick kind of thing in March. That's March 1st to March end of March 2021 there at the end of the chart. And then April and May, you can see we're starting to kind of get closer to historically appropriate levels. This is going to be your best leading indicator on price movement. So number of showings per listing translates into number of offers per listing, translates into purchase price, translates into future list price and purchase price for other similar assets. So I like this chart. I like to see that this is leveling off a little bit. Maybe it'll go back up next month. I don't know. But I think that we're watching this literally day to day, weekend to weekend, as we write offers every single weekend. And okay, you got 15 offers this weekend, you got 10 offers the next weekend. There's a little bit of a lull. So we're encouraged to see that.
I think it's really important to understand that, that dip looks sharp, and you might be thinking, oh my gosh, I just got a house under contract a couple of weeks ago, or I want to buy. There's a long way to go in terms of the number of events that has to happen before there's any change in price. So first it has to be fewer showings, then it has to be fewer offers, then it has to be where you get to where a home doesn't get any offers at all for, say, the first couple of days on market, then the first couple of weeks on market, then the offers soften. Then it's things like inspection contingencies come back, which have been normal for decades and just haven't been a thing for the last several years. Financing contingencies come back. All of the things that are more normal that you might have experienced if you purchased a home, either as an investment or for your own uses over the last, say, 25 years. You would expect like a financing contingency and inspection contingency, maybe some negotiation in price, the seller paying some closing costs, those sorts of things. All of that has just been completely wiped out over the last several years. It's been kind of a slow boil. And then in early 2021, it just was all off the table. So there's a long way to go. Like years of behavioral change would have to happen before prices really come down. But it's interesting to see that this spring, there was kind of a frenzy that led to some behavioral change, which led to extreme price change. But that behavioral change is here to stay. It's not just going to instantly come off the table. It will have to slowly go back down to normal.
Yes, absolutely. So looking at short-term rental, this is a kind of a hot topic for us lately. People asking about short-term rental. Lots of interesting things. There's a lot of discussions we could have about like what things are going back to normal, what things are eventually going back to normal, what things are never going to be the same. So leisure is back in a big way. They're at full capacity and struggling to hire, but business travel is not. And it's an open question as to whether or not business travel is ever going to go back to normal. We think that office utilization is going to go back to normal. People will figure out eventually, probably sooner rather than later, that people need to get together face to face to do business. This is an ironic message to bring to people via Zoom, but it's very valuable. We just had an investor fly out and meet with us Sunday evening, Saturday. So face-to-face business is quite valuable, but business travel is down in an epic kind of way. It seems like there's probably going to be fewer conferences, fewer just less business travel for the foreseeable future. A lot of companies have figured out that we can do Zoom and stuff, and business travel is very expensive. It's one thing to have a work from home employee versus an office employee. It's another thing to have an employee on the road. We're talking, multiple increase in kind of the costs associated with that employee. And so it's likely that hotels are going to continue to struggle, but properties that market to leisure travelers, if you have like a vacation Airbnb, that'll probably be okay. If you have an Airbnb that is marketed to business travelers, that's, next door to a convention center or something, it might be worth considering selling that single family home while the market's hot, because it's tough to see the future where that comes back. Let's talk.
Go ahead.
No, go ahead.
All right, let's talk about new construction. So this is fresh in our minds. We're working on a new construction project. So we own 30 townhomes. We're building another 85 townhomes. We're going to start breaking ground on the next 30. I'll say any day now, because it's been kind of delayed and postponed with lumber prices.
We got a fun chart for that next year.
Yeah, and the bank asking for us to put more skin in the game because of their concern about construction prices and those sorts of things. So this is very much on our minds, and it should be on the minds of every investor, because going back to new home starts and knowing about we have to build our way out of this crisis. Well, how do we do that? How do we do that when the prices of materials are very high, labor is hard to come by, and there's regulation in terms of building code and those sorts of things. So when we think about new construction, what are the things that go into new construction? So first, we need people to build houses, and there's extreme labor shortages in the country. That's probably the single greatest concern for long-term inflation, because when we think about like behavioral change for, say, offer prices on single family homes, it's hard to undo that behavioral change. And right now, employers, in order to attract talent, need to raise the wages that they're offering, improve the benefit package that they're offering. And once that behavior change has happened, it's hard to undo that. So the labor shortages will carry on for a while, and then the increased cost of labor will carry on for quite a while. That might even be like a permanent change at this point. Material costs. So we have several slides here on material costs. But just suffice it to say, almost everything is more expensive than it was a couple of years ago because of changes in the supply chain, the actual creation of those materials, like at lumber yards and factories and those sorts of things. Getting things around the world is a very complicated dance that I know for myself. I really didn't even understand that dance before COVID. I just knew that I showed up to a store, or I pushed some buttons on Amazon and things showed up in my hands. And it's really a very sophisticated dance around the whole world to move those materials around the world. And then as all of this is coming together, and regulation, which we didn't put on here, but building code continues to get more and more strict in terms of safety and radon mitigation systems and other things. And that all leads to escalated costs at a time that the country can ill afford it. We ideally would never have these escalated costs, but if we did, it would be during a time that it was very much like a buyer's market, where buyers wanted to buy more. But right now, buyers need housing, they want to come into housing, and they can't necessarily afford those higher and higher prices. So all of this is kind of coming together and kind of creating a perfect storm or perfect opportunity, kind of however you want to think about it. We choose to think about it in terms of opportunity, because yes, new construction prices are high, but the value of those assets is quite high because there aren't enough of them.
Yep, absolutely. Here's the fun chart. So
we follow this every day.
Yeah.
This is the price of lumber.
I didn't even know this was a thing. I didn't know there was a lumber index until very, very recent past. So what day did we try to close our construction loan again?
Oh, it was like May 10th. It was the peak, and our bank said, whoa, we're gonna pump the brakes on this. We're gonna stop. And we very much said we just want to hold steady. We feel very confident in closing our construction loan. We know that the price of lumber will come down. We want to close the loan and then buy the lumber when price comes down. The bank said they weren't willing to work with that. So we're closing the loan in July, which is fine. We're happy to play ball.
We'll just bring an extra $1 million to closing. No big deal. Yeah.
But this influences everything.
Yeah. Yeah. And it really tells a story of, people are worried about hyperinflation. So this index leads the market by, a week to a month or something like that. You don't see a 2x4 cheaper in the store until there's a latency after this here. And so we're doing our construction loan. We're gonna close. We're gonna put utilities in the ground, put pads in the ground, and then we're gonna lock our lumber when the lumber is a reasonable cost. and that'll probably happen sometime in the next 8 weeks or something like that. We can say that with pretty good certainty because we're looking at the futures markets. And this story is the story throughout the economy. So there's this huge spike in demand and struggles with supply chain, and then finally things start to even out. There's no fundamental, that's out of whack here. Just we can't get the trees in Canada to our job site in Byron, Minnesota, and that's
to Canada.
And we're to Canada. And then there's an interesting cascade effect there. So the lumber yard, they bought lumber in mid-May.
Mm-hmm.
So inventory levels for lumber are actually the highest they've been in years, whereas back in April, they were the lowest they've been in years, which is what created the price spike. Well, the lumber yard has to sell that lumber that they paid a huge price for before they can sell the cheap lumber that they bought last week.
Yeah, and I would say that's something that I see in COVID that's really interesting to me that I've not seen in other times of my life is, we think about Adam Smith and the invisible hand kind of moving the economy. And the economy is very sticky right now. Like in my mind, I see that, and maybe it's because I'm a mom of toddlers, but I see that hand kind of like
Everything is sticky
covered in jelly or covered in, I don't know, lollipop or something that, in a normal world, there's all this demand for lumber. Well, sell the lumber, let's go. But right now, there's this like dance back and forth of the lumber yard saying, well, we paid all this money for lumber like 3 weeks ago. We know that the price has come down, but we really don't want to let go of it. And the builders are saying, we really need lumber. We have all these people that want to buy these homes, and the faster we can get them started, the faster we can sell them and carry on with our business. But we know that the price of lumber has come down, and there's just this like stickiness that that I've never really seen before in the economy. It's the behavior is very off right now because of how COVID changed things, but it introduced a lot of inefficiencies into the system that blessedly the last say 30 years in the global economy have been quite streamlined, and now there's all these inefficiencies that just sort of have to be worked out, that will be worked out in the fullness of time, but it could be a year to maybe 5 years for a lot of this stuff to really kind of shake itself out.
Yeah, and this is the story that's being told throughout the whole economy right now. I'm going to skip ahead to a slide here. I don't actually know how to do that. Sorry, I had a whole career in technology, but I can't run a PowerPoint show. So there's a backlog in Chinese ports right now that's going to mean that your holiday shopping shelves might be a little bit bare, that you may not have your favorite toy or wrapping paper or whatever, because the boats go real slow and they're trying to get containers out right now that will hit the shelves 6 months from now. And it's important to understand that there is going to be crazy inflation in the short term, crazy inflation as a result of these inefficiencies in the supply chain. That's what the Fed is looking at. That doesn't mean that this is here to stay. And there's probably some long-term impacts that are going to be worked out in terms of shortening the global supply chain that will probably be a bad thing for China, a good thing for us. So I really see a little bit of a tailwind from this, but we're making 7-8 figure daily decisions right now based on these dynamics. And so, yes, we're going to close the construction loan. We're going to be ready to take that. It's a little crazy to close on a construction loan and not have your lumber package locked in. That's your number one cost item for residential. And but we know it's getting cheaper because we can see the futures market going down every single day. So lots of interesting stuff. Let's talk about capital markets for a second. This might get a little bit abstract, but real estate investment, you're investing in sticks and bricks, but really what sets real estate on fire is debt. That's the thing that makes it so special. It sets it apart from other asset classes. And the really magical thing about real estate investment is that it's a hard asset backed by paper debt. And real estate investment is the most accessible way for most people to get access to that really unique combination of a hard asset that's like indexed to inflation and cost of living, backed by paper debt that is not, that's vulnerable to inflation. So we talked about the global supply chain. Will there be long-term inflation? There will be some, but nothing like what we're seeing in the short term right now. The thing that everyone needs to be aware of is that there is an ocean of cash out there. So, we have the privilege to sit in on some of these, masterminds and stuff for people who are kind of in the business. And a year ago, there were debt funds that were formed, and billions of dollars went into these debt funds. They're called opportunity funds. So basically, they thought an '08 crash was going to happen. Well, that crash never came. And all that money is sloshing around. These people have regulatory obligation to place that capital or give it back, and they don't want to give it back. And so what's happening is they are writing loans on residential real estate because that's the safest place to put the money right now. That's where all the smart money's going. And this could be the next '08. This could be. I don't think it will be. I haven't heard anyone say it. This is my prognostication. So I, it could be totally off. But basically, there's hungry capital. Like when you get a loan from a bank, the bank wants you to pay the loan. They don't want the house back. They want you to pay the loan. They make money off the interest. Well, these opportunity funds, they started out wanting to buy distressed homes, and now they're writing mortgages, and they want the house. I don't like that. That's something that does not.
It's a disalignment of incentives.
Huge disalignment of incentives. Yeah. So it'll take 5 years just to play out, but this could be on the front page of CNN in 5 years. The moral of the story is don't take a loan from a debt fund if you have the opportunity. The money seems really good right now. They're selling money cheaper, lower interest rates than Fannie Mae and Freddie Mac, which is historically unprecedented because there's just so much billions, trillions of dollars of capital out there looking for a home. But beware of who you're borrowing money from and what their incentives are if they want the asset or they just want the interest. We talked about how interest rates are at historical lows. Just let's appreciate for a second how extraordinarily cheap they are. So our crystal ball. Who knows what the future holds, but let's make some good guesses.
Neither legal nor accounting advice.
Oh yeah.
That's just having a lot of fun.
Let's get that disclosure out there. We're making 7-8 figure decisions based on it.
This is what Nick and I talk about when we're like having lunch together or driving the car together, because we're making these big decisions and we try to provide as much value as we can to you, who we hope are also making amazing decisions like these. We certainly have seen real estate investing radically change our lives for the better, and it has changed how we think about things. We're thinking about the capital markets, we're thinking about global supply chain, and so these are the things that we talk about, or things that maybe we think might happen, and just kind of presenting them to you from an entertainment perspective.
Yeah, and historically we've been right more than we've been wrong. We've been amassing as many single family homes as we can for ourselves and our investors for many years because we saw this coming housing crisis, and now the crisis is here. And we're enjoying double-digit appreciation on a $20 million real estate portfolio that we own. Like that's a significant amount of income. And to a certain extent, I'm sure we got lucky, but I think it's something that we saw many years ago and said, hey, if we just put ourselves in the path of this kind of inevitable looking thing, like we're going to have to really work hard to screw this up. And that's exactly what's happened. So let's take a look at where we think things might go in the near future here. I think it's inevitable that the Fed is going to withdraw support for mortgage-backed securities. So right now the Fed's buying like $40 billion a month in mortgage-backed securities. They did that. They stepped in when the pandemic really hit to stabilize that market and to artificially lower interest rates for homes, for single-family homes, to inject liquidity into that debt market. And there's just too much money out there. And so the Fed has got to reel that back in. It's going to take a while for them to increase interest rates. They're looking at a couple of years out to increase interest rates, but I think they're going to reel that back in. There's going to be a shock event. If you were working with us back in January, we told you that Fannie and Freddie were changing their underwriting guidelines and debt was about to get way more expensive, and then debt was going to get cheaper afterwards. And that's exactly what happened, almost on the exact schedule that we predicted. And so we think that the Fed's going to pull out of the mortgage-backed security market at some point in the next several months. There will be a huge spike in mortgage rates, and then it will probably level off again as the market discovers the price without the Fed's presence in the market. They will not let it go too high, though. So if it goes to like 6%, like they're going to step right back in. They won't let it go. What the Fed's trying to do is
the country has been very conditioned by this.
Yes.
So likely most people that are listening have made all or the extreme majority of their adult financial decisions in that 6.2, 4.09. And so we can think about and we can know that rates were 8, 12, even higher than that, but it feels very unsettling. And so there's going to be this dance that the Fed does to go up a little bit, come back down, go up a little bit, come back down, a slow boil, right? We're just frogs in the pot, so that there's no crisis or feeling of uncertainty. Uncertainty is the worst thing that can happen in capitalism. And so there needs to be a slow, steady, measured hand. But interest rates likely will come up. It will take a long time, but it will happen.
Yeah. The critical thing that I feel like almost no one understands is the purpose of the Fed is not to, maintain a certain interest rate or even like full employment, like they say. The Fed's purpose is to create the illusion, well, these days, the reality of control, that there's a hand on the rudder.
It's not covered in jelly.
That's not covered in jelly. That's right. So the Fed needs to back off, but they need to do it in such a way that there's not a taper tantrum, as you maybe have seen on CNN or whatever. And so really the reality of the situation is much less important than the perception situation. And if there's some inflation or other secondary consequences, that's less important to the Fed than the public having confidence that they have control.
Let's talk about some good stuff
Yeah.
for investors.
Yeah.
So, there's clear indicators. I think all of the experts agree. Certainly when we look at the data, it's our belief that there will continue to be rather large price growth over the next year at
Almost
minimum.
inevitable.
Again, if you've come to several of our presentations, there's these consistent themes, kind of regardless of what we're talking about. There's some themes there, and it's supply and demand. So not enough supply, plenty of demand. That's going to lead to continued price growth. That's also going to lead to rent growth. Rent growth will be a little bit smaller than price growth. That's normal. That's kind of the dance between the price of a home and rent. Rent growth tends to be a little bit slower too. So, just like as a concrete example, homes that we purchased years ago, we've locked in that purchase price, we've locked in that mortgage. Well, just kind of natural human behavior, we're probably not going to push as hard on rents on those properties as properties that we're closing, say, today, and we're paying that higher price. Well, we're extremely incentivized to get the maximum amount we can in rent for that. Obviously, for our management company, we're pushing rents as high as we can. But if you kind of think about like maybe a mom and pop or someone who picked up a rental property along the way and isn't as involved in understanding everything that's happening, they're thinking, oh, well, my mortgage from 5 years ago was $1,300, so I'll rent this for $1,350 instead of, recognizing that rents today might be $1,750 or $1,800.
And it can go both ways. Prices can go down. It's really rare for rents to go down. It's a really unusual thing. Again, just you kind of get locked into place, when you acquire that property, put it into service. So if you can buy into an upward trend, you're going to be in really good shape owning long-term residential rental properties.
Yeah, we certainly don't see any crash in sight. We have invested, during the last 10 years, and kind of every year people have asked us, well, when are you going to stop, or when are you going to hoard cash for a crash?
Or telling us to stop because the crash is coming.
Yeah. And we've always just said, let's just slowly see. We're just going to keep buying. And we just wake up each day and decide, are we going to buy that day? And we did have a pause in all acquisitions for the first several months of COVID. It was the only time in our investment career that we stopped acquiring. But we don't see a crash. And when we think about, my gosh, what if we had stopped 5 years ago or 6 years ago when people
waiting for the downturn when things are affordable?
Yeah. I think this fantasy of 08 is written into people's brain that, oh, well, next time I'm going to wait for the crash and then scoop it all up. Never mind that during the crash, banks don't lend and no one wants to buy and everybody's scared.
Yeah.
But in any case, we certainly don't see a crash coming. And we really think about, gosh, if we had stopped investing 5 years ago, we would have probably 10% of the wealth that we have today.
At best.
At
best.
I'm going to skip down to legislative changes, and then I'll let Nick jump back up to tax changes. I think it's important to know that these numbers are very exciting for investors. I certainly look at these numbers and I get very excited. But these are also, real live people and families. And we talked a little bit about the labor shortage and wages going up. But we also know that wages have been stagnant as compared to the overall economy for many, many years now. And I think growth can only go so far, so fast before there's legislative changes that places that are already tenant friendly will become more tenant friendly. Maybe even places that are right now are very landlord friendly may even see some of that scale tip toward being tenant friendly, because people need housing. Housing is critical to the foundation of society, to just basic order, and it needs to be relatively affordable. We know from cities like San Diego, LA, New York, that housing prices can be very, very high, and those communities continue to thrive and to march onward. But I think it's just important to for me personally, to be excited about the growth that's happening, but also not to hope that it is so extreme that it makes the legislative body say, whoa, we need to do something just to help kind of the average family in terms of their housing costs.
Yeah,
I don't know of any major legislative changes that are happening, but I think that it could happen in, say, a 7 to 10 year time frame if these escalations continue to happen at this very high pace.
Yeah, national rent control or rent control stepping up in more municipalities, regulations to constrict the people placing units into service as rentals, which is it's challenging to live through this because what happens is they put all these regulations into place because they see that homeowners are getting priced out of the market or taken out of the market by investors. But then, like, this is a simple supply-demand equation. They'll put those measures into place and then wonder why there's no rental housing. And the market tends to do a pretty good job of making sure that if there's no one to rent that property, then investor's not going to buy or create that property.
And we have those conversations all the time. There's a small city in southeastern Minnesota. We had a discussion with their economic director, or was that the title? And they were like, oh, we're so excited. We would love to welcome Black Swan in this community. We would love to have you create rental housing here. There's no rental housing. People want to live in this community.
Yeah, 0% vacancy in the whole community. Literally 0 places to rent in a very large community.
Wined and dined us, rolled out the red carpet for us, and then we're like, well, why is this? What's happening? We would love to help you with that problem.
A great opportunity. We'll go start digging tomorrow. Start getting shovel ready here.
And they're like, oh, well, we have a rental certificate, and we're not issuing any more of them.
No new ones being issued.
We're like, oh, okay, so you need us. Y'all need to figure this out yourself. Right. Issue some rental certificates, then call us, then we're happy to help. But there's a little bit of a disconnect there sometimes.
Yep. All right, so just be aware of legislative changes. This is probably one of the biggest impact items, I would say, on the potential future for real estate investment in the next several years. It's the biggest wild card, in my opinion. We're in a mood as a country where we just had the biggest economic intervention in history. And I think that kind of intervention, there's an appetite for it that was not there before. And tax changes, Biden is probably going to double capital gains tax. We're not very political people. Probably not even necessarily a bad thing if capital gains tax were doubled. There's definitely a disconnect between the rich and the poor right now that needs to be remedied somehow. I could care less about that piece of it, though. What I think about is the capital flows. So is capital going to stop seeking a home in certain areas because of those legislative changes? So the advantages of cost segregation, accelerated depreciation, bonus depreciation, those will probably be muted. And the 1031 exchange could potentially go away. And again, these are going to have second and third order consequences. They're very tough to predict. So for example, you might see syndicators a lot less active because so much of what they do is predicated on some of these advantages. You could see just less investment in real estate in general. And here's the thing. If you are investing in real estate for tax advantages, this is probably a bad thing for you. If you're investing in real estate, for kind of its fundamentals and the tax advantages or a bonus, then this could potentially be a good news thing for you. There could be loose capital that comes out of the market, becomes more affordable. There could be a downturn in value in commercial or multifamily as well, probably not single family. So we see some short-term tailwinds here. We see a very exuberant near future. In the long term, 5 years from now, there will probably be some significant headwinds as interest rates go up. There's increased regulation. This run up in valuation kind of takes a breath and maybe even levels off or comes back down. I don't see that for many years in the future, though. It seems to us like people who act now will probably be rewarded. People who go get hard assets backed by paper debt are going to be really, really excited that they did. And people who get into that, they see this crazy upward rocketing trajectory on property values and they decide to get in several years from now, those people will probably not be rewarded. There's a phrase that I think could become ubiquitous here, the decade of the operator. So anyone who got into real estate investment in the last 10 years, they look like a genius. Like they didn't have to do anything in order to succeed because there's been so much appreciation. And right now, I think is a very good time to get in. But if you look at 2020 as a whole, there's probably going to be some headwinds in this latter half of 2020, the decade 2020, that really is going to be decided by who is doing a good job running the asset. Do you have a skilled property manager, a skilled asset manager? Did you buy it right? Did you get the right financing in place? There probably won't be this situation where you can buy anything at any price and manage it half-heartedly and come out ahead the way you could in the 2010s. A lot of things are going to be forever different. Business travel might be one of them, for example, but I think most people probably go back to the office. So some things will be the same, some will be different. You have to make your real estate investment decisions, based on that. I do suspect that residential real estate, people are going to keep sleeping somewhere.
Yep.
So not as much uncertainty in that particular market.
Yeah.
So that's all the stuff that we say, but kind of who cares, right? What are we doing? So we have a big portfolio and we keep growing it. We keep acquiring single family, multifamily assets. We're doing more multifamily right this second because we see an opportunity in that space, the same way we saw this huge opportunity starting around June 2020. But we're still buying like crazy in single family as well. We've got 13 under contract right now. We also have two $10 million apartment complexes under contract right now. Every year our business model changes, right? Like a lot of people I think freak out when they see changes, but like it always changes, and your ability to manage that change and to pivot your business model is what determines your success in the marketplace. So we've always targeted cash flow positive assets, and it's merely a question of how do you get to cash flow positive? How much cash flow positive? But we continue to target cash flow positive real estate investment assets. That's a fundamental that's really never changed. Our way of getting there changes all the time. So that's what we're doing.
We try to be excited by the change. So Nick and I have a staff now, and sometimes our staff will say, well, we're doing things a little bit different than we were 3 months ago. And we'll say, yep, Nick and I have been doing this for 10 years, and it always changes every 3 to 6 months.
Yep.
COVID has certainly instigated a bigger change or kind of a faster change, but we've seen that in everything. Everyone uses Zoom when, in January of 2020, maybe half of the people on this call might have used Zoom before that. So it's always changing. And I think of, it's all about mindset and being excited about the change. And it's like a puzzle to put together or like a riddle to figure out, and having a high level understanding of capital markets and the global economy and legislation and the political appetite out there, and then using those things to make real estate decisions. So there's things like, well, how much does the countertop cost? Or what color paint should we put on the walls? What's the fashionable color? That stuff's all fun. It's great. But these really high level concepts are really what drives real wealth and big decisions.
Absolutely. And as Elaine said it earlier, it's easy to look at the past and say, oh man, I wish I was getting into investing in 2011. But we were in real estate investing in 2011.
No one wanted to do it.
Everyone said we were crazy. Oh, that asset that just had a bubble and collapsed. You're investing in that. You're crazy. There was no credit. There was no capital. Like we have a line out the door of people who want to buy now and have capital in place and not enough places to put it, which is a good problem to have. But I certainly prefer that problem to the problem we had 10 years ago when there were deals everywhere and we knew it, and we could not get anyone to move because everyone was so paralyzed by fear. So, what do we think is the best time to buy real estate?
100 years ago, 1,000 years ago, 20 years ago.
Yeah, but you don't have the luxury of doing that. You need to buy real estate and then wait. You can't wait and buy real estate to make money. So, we recommend you go buy some hard assets backed by paper debt, whatever that looks like for you. Go buy a single family home in your market, where in your backyard, wherever you live, and get a fantastic loan on it, the best loan in the history of capitalism, frankly, and just wait, and you will be successful. You're going to have to work hard to screw it up with the way things are positioned right now. There's a lot of certainty, I feel like, in the marketplace. And you're certainly always welcome to give us a call as well. We're always happy to connect with investors. So you can go block a time on our calendar, sign up for our Facebook group, or we've got a course that'll be coming out this fall. That's going to be a lot of fun. Shoot us an email if you want to connect. But we'd love to serve you any way that we can. So we have our little surprise. Do we want to?
Yeah, let's do it.
Okay. So there's a there's a fun surprise here in today's presentation. We've never done this before, so it's just fun. This deal happened to hit our radar like right as we were preparing for the presentation an hour ago. So this is a live deal. So we haven't sent this out to our list or anything. The people who chose to attend our community hour today get this deal. So this was it's just a great property. It's an exceptionally good deal, I would say. Doesn't need anything. Already has an existing rental certificate. Should rent really easily. Relatively affordable price. That's a photo of the home right there. Should be pretty much a turnkey rental that we can get very favorable financing terms on. It doesn't need to. You don't need to have an all cash, no contingencies offer to get it because it's an off market deal. So if you're interested, go ahead and just shoot me an email here. So nick@blackswanteam.com if you're interested in moving forward with that property. And we'll buy someone a property today. So get your dose of financial freedom. So we'll take a break. We tried really hard here to finish ahead of time for a change. We had a lot of content we blasted through really carefully and really quickly. But we'd love to answer any questions that the group might have. Any thoughts on anything that they saw today? Feel free to unmute yourself and. There's a bunch of people here. We got a vocal group.
Oh,
Jen.
Jen?
Oh, do we not allow people to unmute? Unmute.
Can you unmute yourself now?
Feel free to go into chat if you're not able to unmute yourself.
That property doesn't meet the 1% rule. If you can find us a property that meets the 1% rule, we probably wouldn't buy it, but we'd be very interested in it.
Yep. I mean, we can get you a property in our market that hits the 1% rule, but it's going to be a class, CD property that is probably not going to give you a very good total annualized rate of return.
Yeah, so properties generally have not met the 1% rule for probably at least 5 years. And generally those that do have, they're in challenging neighborhoods, or they're going to have like larger repair, those sorts of things. Higher vacancy rate. So the 1% rule made sense in about 2010.
Yep.
It does not make sense today in the extreme majority of markets, certainly not in our market. It's something we hear people talk about a lot.
Yep.
People ask about a lot. But it's not an investment metric that we've looked at for probably at least 5 years.
Like outstanding advice, again, circa 2010 or whatever, and it can be misleading as well. Like if you have a small multifamily property and you're not hitting a 1% rule, I would be really hesitant to pull the trigger on that deal unless it was a really nice Class A urban core kind of deal. And then if you were hitting a 1% rule on a Class A property or something like that, I'm gonna wonder. What's the catch? So it's all subjective. And anyone else, feel free to jump in here.
I've allowed you to unmute yourselves.
All right. I'll keep answering that question, I guess, and feel free to interrupt me here. So the fun kind of mental exercise I do whenever I'm thinking about the 1% rule is one of our most common questions. So let's say you have a choice between buying one home for $200,000 that rents for $1,800 per month, or buying two homes for $100,000 each that each rent for $1,000 per month. So you get $2,000 per month in gross rents from that second example. Which proposition would you rather take on, knowing nothing else about the opportunity? Feel free to respond in chat. Vicky says she doesn't like having two roofs and two HVACs. Well, you'd be an exceptionally wise individual. I'd say most people in the market. So Jenny says two properties. Yep. Option ones, that's one property. Will the higher rent have higher turnover?
Interesting.
Good question. Two properties. Yeah. So this is a hypothetical, so we can't say necessarily what the right or wrong answer is. But in our experience, you're going to be pretty categorically better off with the one property for the $200,000 and the $1,800 per month in gross rent. And I'd say that kind of flies in the face of conventional wisdom there. So again, we found that having 2 roofs, 2 HVACs, most critically 2 tenants to manage to achieve similar total gross rental rates leads to radically lower long-term profitability. If you think about the kind of tenant that's probably attracted to that property that costs twice as much, you're going to get a higher quality tenant that tends to have lower turnover, lower vacancy, lower turnover costs. You're typically in a higher appreciation area in a better school district or something like that. And appreciation is really your biggest long-term wealth driver. You don't want to invest on an appreciation basis, but you want to make sure you're targeting appreciation. It's a big part of your calculus there. And then some people would say that you might have less vacancy risk because it's unlikely your 2 homes would go vacant at the same time. But we find that those lower end homes, they have way higher turnover, way higher turnover. So your total vacancy is actually much higher as well. You're probably going to get a loan on the $200,000 home at a lower interest rate, a higher quality lending product in general. And you're probably going to be able to find better maintenance people and everything to even work on the properties. There's all these qualitative considerations that weigh into it that tend to trump the quantitative considerations. But that's just a great example, kind of talking about the 1% rule. It's an excellent rule of thumb, but not necessarily the end all be all.
Yeah, so I put in a link there for our single family at scale video series. The very first one, the one that has like the blue kind of paint splotch that talks about the 1% rule, that's like a 45-minute video that talks about how we don't like the 1% rule. We haven't liked it for many years. It's a common question. I want to recognize that it's a very common question. I think if we had invested for the 1% with the 1% rule in mind, we probably would have about half of the wealth that we have today. And so we feel very confident that our analysis there should at least be considered. I'll throw that out there. So take a look at that video, and that's a much more in-depth explanation of the 1% rule than we're able to do here.
Yeah, excellent question. Is that true for 2 150K homes over 1 300K as well? At what price point does it change? So you have to run the numbers. You have to decide what's reasonable, and there's going to be some qualitative characteristics that factor into that, and some quantitative characteristics. So is that $300,000 home like a 6,000 square foot home? Well, that's probably a pretty bad property to acquire as a rental. We really don't like any property that has more than like 4 bedrooms or more than 3 bathrooms. That's just additional CapEx costs that doesn't necessarily drive an escalated rental rate. Whereas if it is a really well located urban core asset that is a manageable footprint that's going to appreciate like crazy, well, yeah, that 300K home may make sense. So it depends on the rental rates you're going to get. It's certainly a qualitative decision first. And then once we've made that qualitative decision about whether or not this is a property that we love and we think is going to perform over the long haul, then we run through the quantitative exercise and decide, is this something that meets our criteria from a financial point of view? And we're frequently surprised, like maybe those 250K homes have exaggerated tax assessments, or the 300K home does, and you've got a $200 per month swing in pure cost that you really can't do anything about, and that really tips the balance in favor of one or the other. Or maybe one is a historic home that has like triple the maintenance cost of the others that are built in the last 20 years. So there's a lot of qualitative characteristics that factor into that. Yeah, excellent question. I love Tracy's comment there. Elaine, I love when you mentioned in a previous webinar about falling in love with the story of the property, human-centered, then do the numbers. That's exactly how we approach it. And that may seem a little bit strange because I know there's a lot of advice out there to do like a quantitative approach. Like I was at a coaching event for this coach who buys 9-figure assets, and he said he we paid a bunch of money to learn how he does all of his quantitative underwriting, and then he stopped himself after kind of going through that and saying, when I buy a property for myself, I walk it, and I usually know in about 5 minutes whether I'm going to buy it. And he's making a $100 million decision based on that. And then he goes back and does the underwriting to make sure he can actually make money at it, but he drives around the area around the asset and walks and just like sits in his car and looks at people. Is this an area that is an area where good tenants want to live, that's going to do well in the long run, and it's for sale and at a reasonable price? Sound good? Or this is a brand new construction asset, and the current owner, the developer, has clearly pulled out all the stops to fill it up and had to make a lot of concessions in order to do it. We don't know who's moving in next door. Maybe some affordable housing could end up getting built next door because there's some nearby multifamily zoning, and it's kind of the shiniest it's ever going to be right now. And 5 or 10 years from now, it may not look so shiny. I don't really care what the numbers are. Like, I'm not going to buy it. There's no way that 5 or 10 years from now, it's likely that I'll be excited that I own this asset, or there's just a lot of uncertainty that goes into it. So you do the qualitative exercise first, and then the quantitative exercise kind of follows that. Yep.
Unmute.
Yes. Yeah.
I'd love to hear your voices. Happy to read this, but if you would like to unmute, go for it, Karen.
Okay. Yeah. And I love the philosophy of buying, looking for that perfect tenant. I just recently purchased a condo that I was going to do for short-term rentals. But in the whole process of it, I just lucked into this person that needed a place. She was getting booted out of her place within the same property, and she has kids and she wants to stay there. And it was just the perfect match. And she wants to do a bunch of the inside upgrades on her own dime that I would have had to have done for the short-term rental business, and probably would have had to have done multiple times, speaking about the flooring and that sort of thing. And she's definitely in it for the long haul. So even though my rent is probably a little bit less than what I would have made for short-term, it just feels better because I'm helping out this single mom with kids, and she's helping me out by taking care of that property. So in the end, it's cash flowing. I mean, it's not huge, but I mean, it is. So I think in the end, it was a good move.
Yep.
That really resonates with us. We keep a bunch of bags of grass seed here, and we'll have a tenant who complains about their lawn, and trying to do sod and seed is really challenging. And so when I'm out and about, I'll just drop off a bag of grass seed and encourage them to plant their own grass seed. And they're usually excited that their landlord even cares about something as kind of trivial as the lawn's looking a little bit bare or something like that. And in order for the seed to work, you have to water it constantly and keep people off of it and take care of it, right? So we could even pay a contractor, it probably costs $1,000 to get a proper professional reseeding done or something like that. But a $50 bag of grass seed in 5 minutes of my time, I can go shake their hand, get a few seconds of just human contact. And I promise you that lawn is going to look beautiful years from now. And all it takes is just an ounce of consideration and a bag of grass seed. And I think that whatever that is, that really is at the center of our approach to property management. I don't think it's hard to find those win-win relationships if you just seek them out.
Absolutely. Any questions related to COVID? We could answer maybe 1 or 2 questions.
Yep.
Any questions you have about your own investment strategy, or kind of what?
You think our crystal ball is broken?
Yeah. Maybe you're like, nope, I totally disagree with everything you guys are predicting, or we'd love to hear. It's helpful for us too to hear what other
challenge our point of view.
Yeah.
Everyone just is so excited about investing in real estate. They're probably out looking for their next property to buy right now.
I hope so.
Yeah. Well, we hope that you got a lot of value out of this presentation. We love just connecting with investors. You're welcome to reach out to us anytime. We're happy to have a 15-minute phone call with anyone for any reason. We just love to connect with people and find ways to provide value. So feel free to shoot us an email, jump on our website, block time on our calendar with our Calendly link, whatever is the most convenient way for you. And we're already serving many of the people in this room here one way or another. And we really appreciate the relationships that we have with each and every one of you. So hopefully you got a lot of value out of this. Feel free to share it with friends in our Facebook group. And we look forward to our next community hour. If there's something specific you'd like to see us cover in a future community hour, just let us know, and we'll go ahead and put it on the docket for our next speaking engagement here.
Thanks so much, everyone. We appreciate your time.